Okay, guys, so welcome to MAC3702, the revision program. We will run 3 sessions. We're going to run today, next week, and the following week. So what we will do, we'll cover between 1 and 2 question papers. What I want you to do, I want to cover 3 question papers in total, meaning I'll cover 1 to 1.5 the year round, and then the remaining you must do. So today we're doing May-Jun 2020. By the end of the weekend, I'm going to select another question paper that you must do, but you will only cover aspects of what we covered today. So today we will be covering, I'm going to just check now, but we're definitely covering part A. So we have May-Jun 2020, which is 1 question of 100 marks. The question paper covers capital budgeting, WACC, working capital and financial ratios, among other things as well. So we will, the question paper is broken up into a part A, part B, part C, and then there's a part D, but part D is just basically additional information. But the main stuff is part A, part B, and part C. That must guide you. That needs to guide you where to find information. Okay, so like 95% of the information will be under a certain heading, and then perhaps here and there you'll need information elsewhere, but that is minimal. Okay, so let that guide you. An exam technique is to read the entire scenario from start to finish, just to get a big picture overview of what the scenario is about. And then you read the required. When you read the required, read all the required. The reason being is you must be, that will help you to pick up if something will fit in somewhere else and so forth. But then, so you read the entire scenario, then you read all the required. And then you'll start with part A, obviously. And then when you start with part A, you need to now see which section of the paper does part A fit in. So for example, in this scenario, part A is going to fit in with part A. So then you just go to part A. Okay, I'm not going to read the entire scenario because then we're not going to get done. So I will just read part A. I'll tell you what I'll read, but the main section is going to be part A. But for you, for exam purposes, read start to finish, read all the required, and then tackle part A. And that will lead you where you need to go. It's very important not to just focus on one part, because you're going to work in silos in that way. You need to see the bigger picture. You need to understand what is the scenario all about. So practice in that way. The structure of the lesson will be as follows. For all of the lessons, we're going to read the scenario, not the entire one, but we'll read the scenario. We'll read the applicable required. And then as we answer the required, we will reiterate the principles and the principles and fundamentals of the topic. So for example, part A is about capital budgeting. I will show you how to pick up that question is capital budgeting, because what's going to be very important when you read a required, you need to identify which topic you fall within. Once you identify which topic you fall within, automatically, so you must train yourself before the exam. You can't do this for the first time in the exam. You have to train yourself when you're practicing for the exam. So what you do, you read the scenario, you read the required. When you read the required, you need to identify which topic are they dealing with. When you identify the topic you are dealing with, just spend about 5 minutes. This is in practice time, not in exam. Spend about 5 minutes to give yourself a summary in your head mentally, or you write it down, whichever works for you. What works for me, just basically a mental picture of what the topic is all about. Not all the details, just a high level overview. You must do it within 5 minutes, if not less, okay? That will then, once you do that, you are training yourself, you are training your brain to think in a certain manner. You're training your brain when you read the scenario, when you read the required. So when you read the required, you're training your brain to identify the topic that is being tested. And then you're also training your brain to provide you with a summary of that topic. That's why you want to do it on a mental level, because your brain is going to do it on a mental level. If you can do it writing down, then in the exam, your brain is going to expect you to write it down as well. So that is what you do. So by the time you come to the exam, there's no need for you to do the thinking. Your brain is automatically going to do the thinking. And this is not far-fetched. If you study neuroscience, so what I do is I read up on neuroscience to see how the brain works, very high level. I'm not a neuroscientist. So like I can give you only like one or two things. But basically, if you understand how the brain works, it's understand the memory of the brain, that you work with a conscious mind, and then you need to go into the subconscious mind. So what is short-term memory? What is long-term memory? There's 3 phases. So there's the way you get it into your long-term memory is by repetition. And what's more important is also to give you, to train your brain how you'd want it to think. Like they say, 95% of the things we do is automatic. It's from the subconscious mind. If our conscious mind had to do everything we do every single day, we would die. We would actually die. So the subconscious mind is running most of our most of the things we are doing without us even know we are doing it. So studies have said that you can train your subconscious mind what you want it to do. I've tried it over the years. It works. So what you need to do is train yourself to learn in a certain manner. So what I'm telling you now, it is hard, but if you're going to do this, that's how you're going to succeed in the end. So what I want you to do is when you practice, what we're going to do now, and what you also do on your own, is practice in the way you're going to write your final exam. If you're going to practice taking path A and you're going to write taking path B, you're basically taking a whole new path. So it's going to be a new game for you in the exam. So make sure, so what I'm saying, don't write on the back of your question paper an answer. Do it how you would do it in the exam. If you will write in the back of the paper of the exam, then do that. But remember, you're going to get no marks because they don't mark the back of your paper. They mark the actual thing you submit. So just be aware of that. As those small things that will make a huge, huge difference. So in sports, they tell you, don't improve one thing by 100%. Instead, improve 100 things by 1%. So the small things, all the little details that you're going to improve by 1% over time is going to help you out. So what you want to do, what we're going to do is, I'm going to go into in a lot more detail, but just to give you a picture, I'm going to read when I read the required, I'll tell you how I identify that this is capital budgeting. Then we will do a quick, like literally in 1 minute, okay, a high level overview of capital budgeting. So that's what you need to train yourself to do when you practice on your own. But then as I obviously answer, because you're not coming here just for exam technique, you're coming here to learn the content, not to learn the content, but to iron out any details. As I do this, answer the question, I'll go a little bit in more detail as to the issues we need to cover. But just so you know, you need to find a way to actually how you're going to prepare for the exam. You can't just one day prepare this way, the next day prepare that way. You need to be consistent, okay? I know you don't have to do the same thing, but there needs to be consistency in what you are doing. So now we're gonna get into it. We're gonna do May-Jun 2020, and we're gonna do part A. So I'm gonna switch my screen. I'm gonna read the scenario with you, and then we will look at the required, and then we will answer the exam question paper. I'm using Google Sheets. So I've created a folder that it's there already. By the end of the lesson, I'll add you to the to Google Sheets. You will get commentator rights only, which means you can comment and you can view. In order for you to make any changes, you're going to have to download your own copy so that no changes gets made on the actual copy I have on the drive. Okay. What I'll also do, I've already shared the question paper in the WhatsApp group. I'm also going to drop it in there. So just everything is in one place. Okay. So now I'm going to share my screen and we're going to go to the scenario. So here you can see it's a 3-hour paper, 100 marks. You can read all of that. What you can see, which you have here as one question, 100 marks, 180 minutes. So what you should know, if it's 100 marks for 180 minutes, then that means every mark you have 1.8 minutes per mark. Okay, so every mark is 1.8 minutes. That is just a rough estimate. Okay, so you must gauge from there. So for example, in part A, the capital budgeting question is 27 marks. So if you say 27 marks times 1.8, then you need to 40. So that means 48.6 minutes you need to complete. So we say 48, you round down. 48 minutes you need to complete the part A, capital budgeting. We're not going to worry on time. You need to worry on time. Okay, very important. You need to worry on time because time is going to get you through the paper. Okay, you want to make sure you answer most question paper, almost all the basically answer the whole question paper. Okay, you don't want to pick and choose. So it's good to take like 1 minute just to plan the question paper. Okay, so I know some people will say that you're wasting 1 minute. Yes, you're wasting 1 minute, but just having a strategy will save you time. Okay, so you don't want to spend now a lot of time, but basically a maximum of 5 minutes. So you want to practice. You can't do this in the exam for the first time because you're not going to know what to do. So it was going to be something new for your brain. So practice before the exam. Okay, so one of the stuff you want to do is before you start reading the question paper, you can see they're giving you this. It's one question, and they're giving you the topics. So there you can see it's capital budgeting, there's WACC, there's working capital, there's ratios, and there's discussion. So you have an idea of what the question is about. Read the scenario. When you read the scenario, read the required, right? Try to identify, but you want to do this very quickly. So you must practice. Identify the big marks. Remember, if you follow the Pareto principle, I don't know if you heard about it, you most likely did, the 80-20 rule, right? What does that mean? That 80%, generally 20% of the topics is going to make up 80% of the exam paper. Okay, so it's not going to be fixed to a particular exam, but in general, right? That and this rule is not specifically to exams. This is a general principle that this guy Pareto figured out years ago. The 80-20 rule, that 20% of the exam of the topics will make up 80% of the exam. Now, what you will identify that WACC, capital budgeting, and mergers is the big topics. WACC, capital budgeting, valuations are the big topics, okay? And perhaps ratios as well. So gauge around that. What's important when you go through, mark out the time you need to spend. Just do those little things that will help you plan. So now when you write the number of time you need to spend, your brain automatically has a gauge. But if you do this, if you practice doing this, your brain is going to know when you put that time, that's the time you need to finish. It's going to speed up the time you need to do. But subconsciously, you are consciously training yourself. And by doing through repetition, it's going to enter your subconscious mind. So that is why when you tell yourself you're not good enough, you're going to fail, and all of those type of things, you are telling your subconscious mind that you're going to fail. So he thinks or she thinks you're going to fail, okay? Because your subconscious mind is doing whatever you programmed it with. So program it with positivity. Program it with telling yourself you can do it. Tell yourself that and why you can do it. Remind your subconscious mind that from past experiences, remind yourself of past experiences of where you did do it. And that will act as a motivator, but not just as a motivator. You're programming yourself to tell yourself, based on past experience, you were able to do it. And one thing that can confirm it, you are here. You are in third year. You came through first year, you came through second year, irrespective of how many times you're writing this thing. You came to third year. The fact that you came through first year, you came through second year, it means that you can come through third year as well. So train yourself on positive thinking. Now, spend some time when you read this. We're taking 10 seconds, actually 5 seconds, to pick up what is within here. Now we're going to read the scenario. Then we're going to read the required. Once we're done with the required, I'm not going to do it, but you must do it on your own. That mark right next to, you most likely printing the paper, mark next to the paper the number of time you need to spend, and then see from there what is being tested. So you're getting a big overview of what is being tested. So that's very, very important. You're just spending literally 60 seconds to plan out the question paper, literally 60 seconds. And then that will set you far ahead compared to someone else. Because remember, in research, they told you, according to research, that why you should limit yourself to the time of a question paper. Okay, so they did research on spending. So for example, like I told you, this is 27 marks, so you must spend 48 minutes. So what they came up with was the following: that if you spend 50 minutes on capital budgeting, that 2 extra minutes you are using is you are getting less marks. You're already 50 minutes into the question paper. So you're kind of exhausted most of the easy marks. The fact that you are still busy on WAC, on capital budgeting question, it means you're not picking up additional marks quickly enough. That is why you're not yet done. But if you take the time and you switch it into the new question, you can, in the 2 minutes that you maybe picked up 1 mark in capital budgeting, you can pick up 5 marks in the new question, because the new question is new, and that means there are lots of easy marks still available. And that is basically what they concluded. That is why when you come to 50 minutes, like in this 48 minutes, stop, then move on to the next. Okay, so do that. And then when you come back, just try to finish up, because what you want to do is that from a practice point of view, you want to finish the entire question paper. Okay, but you need to now solve 2 things. You need to work under exam pressure, and you need to finish the paper. But remember, in the exam, finishing the paper is not what they look at. It's the time. So what you do when you practice, have 2 color pens available. So let's say black and blue. So let's say you're writing with blue first. So you're gonna write for 3 hours. So in the 3 hours, you can only use the blue pen. Okay, so in the 3 hours, you're only going to use the blue pen. But when you do capital budgeting, part A, you must do 48 marks. When 48 marks come, stop, move on to the next question. And you just do, you only write each question within its time. When the 3 hours is over, don't stop, continue writing, because now you're not doing exam, now you want to see whether you know the work. So you swap your color of your pen, whatever color, black, and then you continue. Now you don't worry about time, you already wrote within time. Now you're swapping with a new color and you write with black, okay? So when you are done, now you know, okay, you're finally done, you can't go any further. Now you mark yourself. So you mark the entire paper, but you have 2 sets of marks. You have marks for blue and you have marks for blue and black. So the blue and black is the entire paper. That gives you an indication whether you pass the paper or not. If you pass the paper, you are happy, you know the content. Then you count the blue marks. If you pass the blue, then you're good to go. You know the content and you can pass within time, even though you didn't finish each question. But if you didn't pass the blue, but you passed the blue and black, you know your content, but the problem you have is time. So now you just need to work on your time. So that is a strategy. So why does a strategy work? It solves two important things. Number one, based on the research, like I just told you, is that you score more marks by stopping and starting a new question when the time is over, because the time you're using to continuing the current question, your return per minute is less. Okay, your marks per minute is less by continuing on the question you're busy with, as opposed to moving on to the new question. The second thing, which is very, very important, and the lecture, and I remember one of the lecturers at UCT telling us that when they marked from a psycho point of view, they've actually kind of did a quick, no, they didn't do like a thorough research, but it's a quick thing, and it kind of confirmed their theory or their hypothesis. So people that answer every question, even if it's not complete, pass the exam, as opposed to people that run through as far as they can, but like, let's say 2 or 3 questions they don't touch at all. And one of the reasons is, especially from a psycho point of view, because it's a general exam, right? That after the fact, when the exam gets released, lecturers from different universities now have access to the paper, and they are asked to come up with a solution. Okay, and based on that solution, because different universities work differently, they come up with a holistic solution, and through that they will identify if there were any problems in terms of the required or the time set for the paper and things like that. Then they make adjustments. Now, you will only benefit from an adjustment if you attempted the question. So many times a question was adjusted, but someone didn't attempt it at all, so they can't get the benefit of it. Now, the same thing will happen to UNISA, even though UNISA know what they are doing, because they set their own paper for their own students. But after the fact, when they look at the marks and so forth, they will make some adjustments. You really benefit depending on how well you went through the paper. So just take note of that. So that is why, that's the 2 reasons why you want to make sure you attempt every single question. So stop. The way you're going to attempt every single question is if you stop a question within its time and you start a new question. But if you're going to have a problem where some people have the problem that they can't move on, right? That is something you need to deal with. That is something you need to train yourself to move on. So stop and move on. Even if you think, I know this question, you are wasting time. Rather come back, okay? Because when you move on, you're going to score as much marks in the other questions you have. And if you can't, you're going to stop there as well. And then you can come back to answer the rest. It's going to work. Trust me, it's going to work. So make sure you answer this, because now there's 2 theories that was kind of proven. The one is actually proven because there's real research performed. The other one is based on kind of experience of markers marking for psycho. The same thing will probably happen for per university as well. So please make sure so this first 15 minutes, whatever I spent here, is about not the content, but is about exam technique. It is about how you're preparing for the day. So there are certain strategies. It's not just about writing. Because remember, someone can write 10 pages versus someone that can write 50 pages. The one that writes 10 pages gets more marks because they wrote more quality. So it's not about how much you're writing, it's about the quality of your writing. So plan certain things out, but you need to plan when you're practicing. You can't do it for the first time in the exam. Okay, so now we're going to go on. I'll just run through the paper, then I'll show you what we will be reading, and then we will start reading. Do you have any question at this point, or can I move on? Okay, so no questions. So here you can see there's a high-level overview, let's say a background. So this here is the background. Okay, we have to read the background, otherwise we're going to have no idea what the question is about. Then you're going to have part A. part A, you can see a Rise and Dream project. Okay, when you see the word project, most likely capital budgeting. Okay, so yeah, they have whatever they have over there. So under part A, we have capital expenditure, we have working capital, we have sales, we have operating costs, we have salaries. Okay, then we have part B, which is repayment of debt. Okay, so we have to have a look. What is this? Is this sources of finance, or is this weighted average capital? Is this WACC? Okay, so this could either be sources of finance, capital structure, WACC. Then we have working capital management. Okay, so we'll deal with that. So with working capital management, typical things is one of the two types of questions will come. If it is, if they're dealing with, if they are dealing with debtors, then it will be, again, they'll ask you when a company may want to change the credit policy. That's one example. Another example is they're doing budgets. So then they want to plan ahead, and then you must use current ratios to a plan. Okay, so we'll have a look what that is all about. Okay, and then you have additional information, which gives you certain things that you need to be aware of. Okay, so that is that. And then we have the required. We will come to the required afterwards. So we're going to read the background. We're going to read part A, and then we're going to read part D, because part D is general additional information. We're not going to read part B and part C. What I want you to do is to read that on your own before you come next time, so you have a big picture overview, but we're only going to read part A. So let's start. But there was a question here. Let me just see. Okay, all good. Okay, let's go. Just another thing. One thing is to think deep, but there's a fine balance between thinking deep and overthinking. You don't want to overthink. You want to think deeply, but not overthink. Thinking deeply provides quality. Overthinking creates chaos. Okay. Okay. So they say Eddie Fashion Holdings, EFH, is South Africa's oldest and biggest retailer by assets, and is listed on the Johannesburg Stock Exchange. In the recent years, the company has struggled to deliver impressive results as it faces serious competition from both local and international retailers. The company's share price was trading at 4,598 cents on 1 October 2018 at the start of the financial year, but had lost about 52% of its value by the end of September 2019, as it recorded a net loss of 109 million rand. With no dividend declared at the end of the year, this loss brought the company's net assets value down to 1,269 billion rand. Okay, so EFH significant shareholders include the Public Investment Corporation, Rembrandt Group, and African Rainbow Capital. Only 50% of the company's authorized shares remains unissued. So there's a lot of information that is general. Like I told you, when you read a required, they will direct you to a certain part of the information. So for example, when we do part A, they take us to this part cap A, Arise and Dream project. However, there will be certain information that will be elsewhere in the scenario. So here's a lot of important information over here. Okay, so you must be aware. So one, they gave you the share price at the beginning of the year, but we may not need the share price at the beginning of the year. We may need the share price at the end of the year. They told you during the year, or as at the end of the year, the share price lost 52%. So that means the current share price is trading at 48 cents. The current share price is trading at 48% of the share price at the beginning of the year. So that you must take note of. They're also telling you what the current, what the loss for the year is. They're telling you what the net assets is at the end of the year, and then they're giving you the shareholders. Okay, so they're giving you who are the shareholders, and you can see that. And they're also telling you what percentage of authorized shares are issued. Okay, so they're telling you 50% is unissued, therefore 50% must be issued. Okay, so just take note of that. There's some key information over there. They say the company has approached the industrial development company for a possible capital injection into the business of up to 8,850 million in order to pay off its interest-bearing debt, increase working capital levels, and embark on a new expansion program. EFH requires 600 million rand for its Arise and Dream project, 8 billion to repay its long-term debt, and 250 million to manage liquidity for the next few months. IDC has proposed that EFH issue new EFH ordinary shares in return for the capital injection into EFH business. Okay, so there you can see what they want. They want 8, we know, you can see the split. Okay, so 8 million is for 8 billion is for repayment, 600 million is for the Arise and Dream, and 250 is for liquidity. So that information may not be given again in each part, so you must be aware of that. Remember, in return for that 8, the what you call it, the ones share capital, ordinary shares, they never told us how many shares, so we'll have to figure out. We may have to figure out how many shares needs to be issued. Okay, so that's very important to take note over there. So here's a lot of general information over here that impacts each particular section. So now let's move on. Part A. Arise and Dream project. EFH will be embarking on a new comprehensive business model that is aimed not only at revenue generation, but also at empowerment of upcoming and aspiring young designers. The EFH procurement team has already identified 4 of South Africa's top young designers to be part of the new clothing range called Arise and Dream. The designers will conceptualize and design the clothes, which will then be sent to EFH's trusted local manufacturers to manufacture the required quantities for all its 350 participating stores. Once major alterations and renovations have been completed at these stores, Arise and Dream clothing range will be sold for a period of 5 years, ending December 2025, before the range becomes out of fashion. So as you can see, the capital investment project is going to be 5 years. Okay. It is estimated that afterwards, the company will be able to find substitute products to sell utilizing space previously occupied by Arise and Dream clothing range. Each store is expected to generate an average trading profit of 65,000 Rand per annum on the extra space going forward, after taking into account future wear and tear allowances. The trading profit will increase at 4.8% per annum. Okay, so there you can see the trading profit will be 65,000 per annum. Now that is per store, okay? The final 4 top designers with the designs showcased below are, okay, Nkosi, Amanda, Mbani, and Jacques. Okay, so let's have a look. So there you have Amanda, we have Nkosi, which is Style for All, then we have Imprint, which is Mbani, and then we have Frills, which is Jacques. Like, who buys stuff like this? Okay, definitely not me. I'm not into these kind of clothing. Okay, I don't know what in course he makes. Okay, anyway, so let's have a look. Capital expenditure. They say the first 2 years, 2020 and 2021, will be for the construction phase. However, Arise and Dream sections at all participating stores will be operational at the end of the first year. Okay. Full capacity will only be reached at the end of 2023. At the start of the project, EFH will spend 245 million on alterations and renovations, and another 245 will only be spent a year later. These qualify for 5% wear and tear allowance. Okay, so 245 and 245, what does that equal to? 245 times 2 comes to 490. Okay. The balance below, the balance of the project amount will be spent between store fittings and working capital. See note number 3. So remember, they want 600 million for Arise and whatever for this project. Okay. They're telling you that 245 year 1 and year 2 or whatever, 245, we'll see which years. So 245s will be spent on alterations and renovations. So that comes to 490,000 Rand, 490 million. They asked for 600 million, so that means we left with 110 million. They're telling us that the 110 million will be spent between store fittings and working capital. Okay, so they say working capital will be equivalent to 50% of the store fitting costs. Okay, so we'll have to see what is the store fitting cost. Store fittings will also be purchased at the beginning of the project and are subject to a capital allowance of 20%. Wear and tear as well as capital allowance are only deductible once the stores are opened and operational. Okay, so pro rata applies. Okay, so we also have to have a look at that. So they say store fittings will also be purchased at the beginning. Okay, so working capital. The working capital will only be required once Arise and Dream sections at all participating stores are operational. So remember, they told us when they're going to be operational. 60% of the total working capital requirement will be provided for in the first year of opening the stores, with the balance being provided in the following year. Only 90 cents in a rand of the invested working capital will be recovered at the end of the project. Okay, so I'll explain this as we do the question. Number 3, sales. The young designers have signed a 5-year agreement to design the clothing range to be sold at 350 participating stores. The range entails men's, women's, kids, footwear, and accessories for every occasion. The expected number of units to be sold by each designer per annum are given below, with the starting average price per item. Arise and Dream clothing line is priced at a markup of 50% on cost. Manufacturing costs include designers' fees paid for the 4 young designers. So there you have the design, cherry, lace, imprint, style, number of units per store. Okay, so number of units per store. Remember that number of units per store, 2,000. So it's 2,000 for each. Average price per unit, it is 200 Rand. We need to look at point 1 and point 2. Then they say expected annual capacity. 2021 is 55%. 2022 is 90%. 23, 24, 25, 100, 100, 100. Okay, so that is important to take note. So they say note number 1. This is at full capacity per store per year. So remember, there's so it's per store per year, and there's 350 stores. Okay, there is a demand spread. There is a demand spread evenly throughout the year for all the products manufactured each year. All 4 clothing labels will be available at all participating stores. Okay, then number 2, the average price per unit is the price at the start of the construction phase. Okay, so that is the start of the construction phase. The selling price will increase by 6% per annum. We need to ask us, find out when is the start of the construction phase so we can know when to apply the 6% increase. Okay, so there's lots of information going on over here, but it's for you to keep your principles in mind. Remember, when it comes to capital budgeting, there's 5 principles we need to keep in mind. So we will come to that now. Then we have operating or trading costs. So expected operating costs will amount to a total of 30 million rand per annum for all participating stores, excluding marketing costs. These operating costs will be incurred at the same time the revenue is realized. Okay. The company will also be embarking on a 3D marketing campaign for its new clothing range. The 3D marketing will display the new clothing range using a 3D clothing visualization technology at various shopping centers where the participating stores are located. Payment for relating costs made in advance will be 2 million in the first year of launching the clothing range, but will reduce by 20% based on initial marketing costs in each of the following year. Excluded from the amounts above is an annual depreciation charge of 10% on buildings and 25% on equipment and fittings. Depreciation is only accounted for once the assets has been brought into use. Okay, so remember, in financial management, we only focused on cash flows. Depreciation is a non-cash flow. So the fact that it is excluded, we want them to be excluded, so we do nothing with it. Okay, if it was including, we'd have to remove it. Now let's have a look at salaries. Salaries, the company will have to contract a digital marketing manager, and Sethu with 8 years experience in the advertising industry has already been identified. Sethu will likely start at the beginning of 2020 in order to familiarize herself with the business. The job requires her to manage, develop, and expand the marketing department with current marketing technology, models, and tools. She will be responsible for, bullet point number 1, creating efficient, effective advertising strategies in digital spaces to promote the new clothing range. Focus on increasing sales and brand loyalty by holding events or campaigns to increase awareness and surveys. No interview have been conducted with her yet, but her expected salary for the 2020 financial year will be 982,000 Rand with an expected increase of 8% per annum, and included in this amount are the following. Annual contribution to the retirement fund of 100,000, a once-off reallocation cost of 38,000, and a sign-on bonus of 100,000. These amounts will be paid at the start of the contract. Sethu was referred to EFH by one of the reputable recruiting agencies, and the agency will be paid 120,000 Rand for their work in identifying the suitable candidate for this job. This payment will be effected at the beginning of 2020. Okay, so let's have a look. We're not going to look at part B, because part B is a repayment of debt. We don't need that. Part C, working capital. And we look at the additional information. They say EFH undertakes projects that have an internal rate of return of at least 20%. As at 30 September 2019, EFH had 840 million authorized ordinary shares. The South African corporate income tax rate is 28%. Prime lending rate is 10.25, and the cost of equity is 15.2. Okay, not all of this is applicable to part A, but it's general information that will be used throughout the question. Okay, so let's have a look at at the required. So part A, so we're going to focus on part A because part A is quite huge. They say by calculating the internal rate of return, determine whether EFH should undertake the Arise and Dream project. Okay, so when you see internal rate of return or when you see NPV, then you are in capital budgeting. Okay, so they're telling you using internal rate of return, or if they say use NPV, you know in capital budgeting. If they don't tell you which method to use, then you must use NPV. If they don't tell you which method to use, you use NPV. But the question would be, how do you know you're in capital budgeting? They're telling you to determine whether EFH should undertake the Arise and Dream project. The moment you need to make a decision or evaluate a long-term project. What is a long-term project or a long-term investment or a long-term asset? It is a project, investment, or asset that generates cash flows over a period of more than 12 months. You know, Arise and Shine, or Arise and Dream is going to generate cash flows over a period of 5 years. So that is more than 12 months. So that makes it a long-term project. You need to make a decision regarding a long-term project. So that means you fall within the topic of capital budgeting. We do not need to think so deeply over here because they're telling us use internal rate of return. Internal rate of return is using capital budgeting. If they say use NPV, then you know you're in capital budgeting. But what if the question just said, determine whether EFH should undertake the Arise and Dream project? If they are silent, you must use NPV. But before you can decide to use NPV, how do you know you're in capital budgeting? You are making a decision regarding a long-term project or a long-term investment. Here, you're making a decision, or if they say evaluate. So evaluate is also making a decision, you know, coming up with an answer. So remember, to make a decision, you need some information to help you make the decision. The internal rate of return or the NPV will help you to make that decision. So when you have to make a decision regarding a long-term project or a long-term investment, then you fall within the domain, you fall in the topic of capital budgeting. When you realize you're in capital budgeting, you must know the purpose of capital budgeting is to help you to make a decision whether or not you should go ahead with an investment decision. So the purpose of capital budgeting is to help you to decide whether or not you should go ahead with an investment decision. The way you're gonna what's gonna help you is using a capital budgeting technique. You have 4 capital budgeting techniques: NPV, internal rate of return, payback period, discounted payback period. When you want to make a decision, you must make a decision using NPV or internal rate of return. You shouldn't be making a decision using the payback or the discounted payback period. The critical principles of, or the fundamental principles of capital budgeting is 5. Number 1, in no particular order. Number 1, you only focused on future cash flows, future differential cash flows. So that means no past costs and no non-cash flows. Number 2, the timing of cash flows is very important, and they're testing the timing of cash flows quite a bit in this scenario. The timing of cash flows is very, very important. The way you will, we deal with the timing of cash flows is to know which column to put it in. So we are going to have 2020, 2021, and so forth. So each column represents cash flows taking place at the end of the year. So if something happens at the end of the 2021 year, you put it in the 2021 column. If a cash flow happens at the beginning of the 2021 year, then you can't put it in the 2021 column, because the 2021 column represents cash flows happening at the end of that year. So then where do you put it? You put it into the previous column, because the end of 2020 is the same as the beginning of 2021. Okay, so that's important to take note. Number three, what did I say? Future differential cash flows, timing of cash flows. Number three, all amounts needs to be after tax. So if this company is subject to income tax, we need to take tax into account. So that's very important. Okay. Number four, you must bring in opportunity costs. So I don't think there's any opportunity costs over here, but if you're foregoing something as a result of choosing this project, you must bring that in. There's nothing like that over here, so there will be no opportunity costs. Number five, you must separate financing decisions from investment decisions. So for example, if they gave you finance costs, you don't bring finance costs into the calculation, because finance cost is a financing decision and capital budgeting is an investment decision. That's one reason. The second reason is we're going to use a discount rate. The discount rate takes into account the financing component. So if you include the financing in the capital budgeting part, that means you'll be double counting financing. So that are the 5 principles. So each time you get stuck, ask yourself, does it meet any of the 5 principles? If it does, bring it in. If it does not, do not bring it in. Okay, so now we're going to deal with this. There's one complication over here, which we'll have to figure out. It shouldn't have been this way, but we'll have to figure out how we're going to deal with it. Okay, so when it comes to capital budgeting, when it comes to WACC, when it comes to valuations, you need a reference point. So a reference point means you need a date to work with. So you look at part B. Part B says, using market values as at 30th September 2019, calculate WACC. So they're giving you a reference point where you need, what date you need to use to calculate WACC. The same thing is true for capital budgeting. We need to know at what date do we need to base the internal rate of return. We need to know at which date we need to base the capital budgeting technique. They're not telling us, so we kind of need to figure it out. In the real world, you shouldn't be guessing this. Okay? They should be telling you, but I guess there's probably certain stuff that they want us to figure out. So we will read again carefully the introduction of part A to identify what is our reference point. Is it 30th September 2019, which is the current financial year end? Is it 30th September 2020? Is it 30th September 2021? Okay, so we'll have to figure that out. So we'll have a look at it now. I'm going to stop the share. I'm going to go to my the Google Sheets so we can start setting up. But while I open up Google, do you have any questions? Okay, you should see Google. Okay, so remember what we're going to do when we want to work out IRR. The way you work out IRR is still to set up an NPV calculation. So we're still going to set up NPV, but instead of calculating NPV, we're going to calculate IRR. I'll show you how to do it with a financial calculator. It's slightly different when we're doing it here on Excel or on Google Sheets, but I'll show you how you would do it in an exam, okay? So we will have details. Okay, so we'll have details, and we're going to have year 0. Okay, then we're going to have the number of years. Before we can put a date to it, we need to identify when is year 0. Is it 30th September 2019? Is it 30th September 2020? What can give us the idea is that year 1 is 2021, right? If you use that information over here, if we use this information over here, where are we? if we use the information under sales, if we use the information under sales, where is this now? So here you can see year 1 is 2021. Okay, so the first year making sales. So here they're telling you this is full capacity per store per year. There is a demand spread evenly throughout the year for all the products. Okay, all 4 clothing labels are participating. Okay, so we're happy with that. The average price per unit is the start of the construction phase. The selling price will increase by 6% per annum. Okay, so here this may indicate that this is year 1. But let's go have a look at the top where the construction phase start. When the construction phase start, that is most likely going to give us an indication of when the project starts. So here they say the first 2 years will be 2020 and 2021. So year 1 is 2020 and year 2 is 2021. So they're kind of telling us when is year 1. So that means if year 1 is 2020 and year 2 is 2021, that will indicate to us what is year 0. So that means year 0 has to be 30th September 2019. Are you happy with that? Because that is critical, because if that is wrong, basically the rest of the question is going to be messed up. Are we happy with identifying that year 1 is 2020 and year 2 is 2021? So that means year 0 must be 2019. Happy with that? So I'm going to put in here 2019. Here is 2020. Okay, so if I do this, we must go up until 2025. Okay, so this will be okay. Okay, so that will what you call it. So remember, you read a project is 5 years, but if you count from here, if you count, that is 1, 2, 3, 4, 5. So for the designers, they sign a 5-year contract. They only start from here onwards, but we need 2020 to do construction. Okay, and then there's still going to be some more construction in 2021. Okay, so just think about it logically. We may be used to, when we see agreement is 5 years and the whole thing is 5 years, but you need to understand if you enter into, so for example, like to become a registered institution, okay, so you want to become a registered university, like for me, I want to become a registered university, right? So if it takes 2 years to become registered, so if I start at the beginning of, what is this year, 2021, it will take 2021 and 2022 to become registered. So when does the first registered classes start? Only in 2023. But there's a lot of planning and expenditure happening in the background, but you only start making money from, or you start only having registered students from 2023, right? So same thing over here. They're only going to start making money, start making sales from 2021. And the agreement with the young designers is from 2021 to 2025, which is a 5-year period. But construction and renovations is not starting from the year they're selling, but they're starting the year before. So just take note of that. So you need to just sit back a little bit and think of it logically. Take yourself out of the student mind and put yourself into a reality mindset. So move out of the student mindset and go into the reality mindset. And then ask yourself, if you must sit back and think about this logically, doesn't make sense. And to me, it does make sense. Most of you work, so you should be easy for you to take yourself out of the student mindset and think about this from a real world perspective. So it makes sense that although they mentioned 5 years, 5 years only is a 5-year contract with the young designers. It does not mean the project is 5 years. The project starting from 2020, which is actually a 6-year project. So just be aware of those subtle difference, those subtleties. Because I know when we see a project agreement, or do we expect that to be the life of the investment? That is not necessarily the case in this case. So just be aware. Don't let that throw you off. Think logically, okay? And financial management is about logic, okay? I mean, there's some obviously illogical things as well, but to a large extent, there's quite a bit of logic into it. Okay, so we have some questions now. Okay. So now let us deal with the rest. So the best way to deal with this is to actually go it in chronological order, so you don't miss anything. Okay, so I'm going to be switching between Google Sheets and between the scenario. Okay, so you should be able to see both as I switch between. Okay, so now as we read, we know what, okay, so nothing over here. We know there are 350 participating stores. The clothing range will end, they'll have a clothing range for 5 years, ending 30 December 2025. Okay, so we have that taken into account. They say it is estimated that afterwards, the company will be able to substitute products to sell utilizing it is estimated that it is estimated that afterwards the company will be able to find substitute products to sell utilizing space to sell. Well, I'm not reading this properly. It is estimated that afterwards the company will be able to find substitute products to sell utilizing space previously occupied by a Rise and Dream clothing range. Each store is expected to generate an average trading profit of 65,000 Rand per annum on the extra space going forward, after taking into account future wear and tear allowances. This trading profit will increase at 4.8% per annum. Okay, so what they just mean, so just think about it. They are renovating the stores. They're renovating 350 stores, right? For the Rise and Dream project. The Rise and Dream project is only expected to last for 5 years. So are they going to spend so much money just for 5 years? And the answer is no, because remember, they're creating a separate section for the Rise and Dream section. So they're spending money on creating that section. When the Rise and Dream project is over, they're not going to leave that section blank, and they're not going to leave it empty. What they're going to do, they're going to find other products that will fill up that range. And they are saying that after the Rise and Dream project is over, so after 2025, from the year 2026, each store using the substitute products will generate 65,000 Rand per annum, and that will grow by 4.8% into the foreseeable future. All they are doing over here, they are basically using a Gordon growth model. Okay, so this is the perpetuity formula. So you might just picture this from a valuation point of view. When we do valuations, we have an explicit period, and then we have a terminal value. You should have remembered this from the valuation question we did not too long ago, that you have a explicit period. Your explicit period is the actual number of years, in this case 6 years, and then you have a terminal value. The terminal value is that value that calculates the valuation into the foreseeable future up until the end of time. So from the end of the explicit period up until the end of time. So this is what they're telling you over here. After 5 years, after 2025, the Rise and Dream range comes to an end. But they're still going to have that space. What are they going to do with that space? They're going to get other products to fill up that space. Those other products will generate a trading profit of 65,000 Rand. So what you're going to do, the 65,000 Rand, we will basically, that 65,000 Rand will generate a return into perpetuity. So we're basically working out a valuation using the dividend growth model. We can't call it dividend growth because it's not dividends. So we just call it the Gordon growth model, or we call it the perpetuity formula. Okay, so just be aware of that. So we can bring that in. I'll bring that in because we're already reading it. So to avoid losing out, to avoid forgetting about it, I'll bring it in. I'm just going to put it over here, which I'm going to use the first 2 spaces for the cost. So you can call it whatever you want to call it. I'm just going to say cash flow from extra space foreseeable future. Okay, then how to spell it? How do I spell foreseeable future? Okay, so because the information is right on top, I'm bringing it in 1 time. So now I'm going to have my workings. I'll just bring workings over here. So working 1. So this is the extra space for the foreseeable future. How are we going to calculate it? You're going to use a Gordon growth model or a perpetuity formula. Okay, so you're going to use a Gordon growth model or a perpetuity formula. Effectively, you're using a free cash flow valuation. Okay, so what you're going to just say, the value equals free cash flow 2026, free cash flow 2026 divided by free cash flow 2026 divided by, try to think quickly now, what would be the best way to do this? It's going to grow by that, okay. Divided by our WACC rate minus growth. Okay, so we're going to need a WACC rate minus growth. So our free cash flow 2020 the free cash flow 2026 was given to us as 65,000 Rand per annum, but it is for 1 store. There are how many stores? There are 350 stores. So 65,000 times 350 stores. Okay, so each year, all the stores will generate that amount of money. 22,750,000 Rand. We don't know what WACC is, so I'll leave that out. And then we know what the growth rate, they told us the growth rate is 4.8%. They told us the growth rate is 4.8%. Okay, so we'll have to figure out what WACC is. So as we go through, we'll have to work out what is WACC. Actually, they gave us what the internal rate of return is 20%. So we can actually basically just use that, but we'll come to that now. So what's important to take note is the following. They gave us certain information, right? But they also gave us a 65,000 Rand. We need to bring in the 65,000 Rand is basically the terminal value for the extra space. They're only going to generate money from the Rise and Dream project for 5 years up until 2025. Thereafter, that space is still going to be available. So what they're going to do, they're going to get other products to put in that space to make sales. That other products in that space will generate 65,000 Rand per year. So that is why we need to bring that into our valuation, because that will play a role in our investment decision. Okay, so we will have, what we're going to have. So remember, 65,000 Rand per year per store. So we're bringing in all the stores. So that's why we've got the 22,500. I need to figure out what WACC is as we read through the scenario. I'll figure out WACC, but at least I already have a calculation going. So now I know I'm not going to forget about it. So now we can move on with the scenario. Now we can deal with capital expenditure. So they're telling you that the first 2 years will be for the construction phase. Okay. However, a Rise and Dream sections at all participating stores will be operational at the end of the first year. Okay, so the end of the first year is 2020. Okay, so meaning if they're going to be operational at the end of the first year, they'll only really start generating money in 2021. Full capacity will only be reached at the end of the 2023 year. Okay, they already told us this. They gave us this information also in, the sales section. Okay, they say at the start of the project, EFH will spend 245 million on alterations and renovations, and another 245 will be spent a year later. So another 245 will be spent a year later. So they're saying that the first will be spent at the beginning of the project. Where did I read that now? Yeah, they said at the start of the project, EFH will spend 245. When is the start of the project? The start of the project is the beginning of 2020. The start of the project is the beginning of 2020 because year one is 2020. So therefore, the start of the project is the beginning of 2020. Now, like we said, each column represents a year. The 2020 column represents the end of 2020. The 2021 column represents the end of 2021. So if cash flows happen at the beginning of 2020, what do we know? Where does it need to be taken? Where do we need to put it in? We can't put it into 2020. We'll have to put it into in 2019. So the first cash flow of 245 will happen over here. Capital expenditure. So capital expenditure, remember what is important to take note, capital expenditure, the first 245 million will be spent at the beginning, at the start of 2020, at the start of the first year. The start of the first year is 2020. So the cash flow is happening at the beginning of 2020. We can't put the cash flow into 2020 because that column represents the end of 2020. So to put something that happened at the beginning of 2020, we put in the period before. So therefore, we put it in 2019 because the end of 2019 is the same thing as the beginning of 2020. So it's an outflow. So therefore, it's negative 245 and it's million. So it's 123, 123. Okay. Then they said, and another 245 will only be spent a year later. So the first was spent at the beginning or at the start of 2020. The second will be spent at the start of 2021. The same principle applies. The amount that you spend in the start of 2021 can't go in the 2021 financial year. Why? Well, not financial year, in the 2021 column. Because 2021 column represents the end of 2021. So to put something at the beginning of 2021, you put in the previous column, because the end of 2020 is the same as the beginning of 2021. This is the principle of the timing of cash flows. Remember, one of the 5 principles, timing of cash flows. This is it over here. Okay. 245, 1, 2, 3, 1, 2, 3. Okay. So we're happy with that. Now, that is that. Then they say the balance of the project amount will be spent between the fittings and working capital. Okay. Working capital will be equivalent to 50% of the store fittings. So whatever the store fittings is, 50% will be, whatever the store fittings is, 50% of the store fittings will be working capital. Okay. Store fittings will also be purchased at the beginning of the project and are subject to a capital allowance of 20%. Okay. So remember, the capital expenditure is 5% per annum, and the capital allowances is 20% per annum. Wear and tear as well as capital allowances are only deductible once the stores are opened and operational. Okay, so what's important? So when are they open for operation? At the beginning of 2021. So we can only start depreciating from 2021. Okay, very, very important. Okay. Okay, so now we need to work out working capital and we need to work out the store fittings. Okay, so let's go and work that out. So here we'll put in store fittings. And we'll put in working capital. Okay, we'll put in working capital over here. So let's go work out what are the store fittings and what is the working capital. Remember, working capital is 50% of store fittings. So working 2. So what was it? Total funding required, or total capex. Total capex is how much? 600 million. 600, 1, 2, 3, 1, 2, 3. Okay, capital expenditure. Capital expenditure is, let's put this here, total project capex 600 million. So remember, this is going to equal 245, 1, 2, 3, 1, 2, 3 times 2. Okay, so the remaining balance. So the remaining balance will go against store fittings. So remaining balance. Okay, will go between store fittings and what's the other one? Store fittings and working capital. So that minus that will give us what we wanted, 110 million. Okay. Now we know we must split between store fittings and working capital. And working capital. They said store fittings is 50% of working capital. So that means, they said working capital is 50% of store fittings. That means store fittings is twice the amount of working capital. Okay, so basically what we will do, we will just say 2:1, because if working capital is 50% of store fittings must be double the size of working capital. Okay, so therefore we can just say 2:1, and this will give us a total of 3. So that is not financial management, that is mathematics. Okay, so if you did not know how to deal with it, make up a number. You will lose it over here, but throughout the question, they're going to mark you right. So don't leave it blank. Leaving it blank, you get 0. Making up something we couldn't figure out that is 2:1, make up a ratio. You will just lose the mark over here, but then they will carry the wrong number through your calculation. So that is part of your strategy. If you can't figure out something, make up something. Okay, needs to just be reasonable at least. Okay, so this is our total. Okay, so that's an equal to the sum just see this correct now. What you call it is 50% of working capital. Yeah, it has to be like this. We'll see if it makes sense. 1/3, 50% of working capital. Yeah, I think it must be like this. We'll see if it comes out right now. They are 50%. 2/4, 4/6. I don't know. We'll see now. So remaining balance. It's not going to work out, but anyway. So store fittings as a ratio of total multiplied by remaining balance 73. Not going to work out. These at 50%. Let's just see. That divided by that. Yep, it's 50%. Okay. So there we go. So you need to figure out a way how you're going to figure it out. So basically use like a ratio of this nature. They said working capital 50% of store fittings. So like for me, the way I understand maths, if that is 50% of if working capital is 50% of store fittings needs to be double the amount of working capital. So I just assign a ratio, like do this, okay? So what you call is double. So you can see 2 is twice the size of 1, okay? That's double, okay? So if you add them all up, it is 3. So when you cut the pie, up into 3 parts, and 2 of the parts goes to store fittings, and 1 of the parts goes to working capital, okay? It ends up being 50% of it, whatever it is. Okay, so that is basically how it works out. So basically what you call it gets two pieces of the pie, and what you get 1 piece of the pie, which means working capital has half the amount of the pie relative to store fittings. Okay, so there we go. With store fittings have 2 pieces, working capital have only 1 piece. Okay, so just think about it. If you read it, make sure you can figure that out. Like I said, if you don't want to spend now 10 hours figuring that out. If you can't figure it out in the first 5 minutes, make up something and move on. Okay. That's all part of your learnings. So if you can't figure it out, make up something and move on. Because ultimately, you don't want to get 100% for working capital. You want to get a pass for the paper. So to get a pass for the paper means you just need to move on if you can't figure that out. Okay, so now we're going to go to store fittings. So they said store fittings is that price. So we can go plug in. Store fittings also happened at the start of the project. So therefore, I will say equal. Store fittings also happened at the start of the project. So it's an outflow and go into. So it happened at the start of 2020. It can't be in the 2020 column because 2020 represents the end of 2020. So therefore, we have it at the beginning of 2021. I just want to make sure it is the start of 2020. Was between store fittings. Okay, working capital will be equal. Okay, store fittings will also be purchased at the beginning, at the start of the project. The start of the project is 2020. Okay, so at the start of 2020, we put it in 2021 financial year. For them, I will do that so they can see where I got the answer. So working 2. Okay, they're going to find that answer in working 1. Okay. Now we must deal with working capital, but we need to go read point 3 for working capital. Okay, so we need to go read point 3 for working capital. Okay, so for working capital, so they said the working capital will only be required once the Arise and Dream sections at all participating stores are operational. Do you remember when they are operational? No, where did they say that now? They say, however, Arise and Dream, all participating stores will be operational at the end of the first year. So the end of the first year, they're going to be operational. So they say the working capital will only be required once the Arise and Dream sections at all the participating stores are operational. They're operational at the end of the first year, so the end of 2020. Okay, 60% of the total working capital requirement will be provided for in the first year of opening the stores, with the balance being provided in the following year. Okay, so it's going to be ready. So the stores are ready at the end of 2020. Okay, so the stores are ready at the end of 2020. Are you happy with that? Now, they can only be able to operate from 2021. If they ready 2020, they can operate in 2021. They're ready at the end of 2020, so they'll operate at the beginning of 2021. So therefore, working capital you have before the time. So because working capital is ready, because the stores are ready at the end of 2020, they can really start operating in 2021. But because we need it at the beginning of 2021, we'll put the working capital the year before. Okay, so that's very, very important. So this is going to equal that amount. This is going to equal working capital times 60%. Okay, so working capital times 60%, that's going to be negative. And then in the following year, we'll have the other working capital, which is C29 times 40%. Okay, so that will add up to what we want, 36,366. Okay, so that is it over there. I'll just tell them to look at working 2. I just quickly have a knock at the door. Just give me 1 minute. I'll be back now. In the meantime, just look through this And then when we come back, I'll first ask if you have any questions, and then we will continue. Just give me 2 minutes. Okay, guys, I'm back. Do you have any questions? Can we move on? Or do you have any questions? Any questions? No? Are we happy? How are you finding the questions so far? Let me quickly gauge. How are you finding the questions so far? Difficult, manageable, easy? Taylor? Too much reading? You must brace yourself for that. Prashini, how are you finding it? Okay. What do you call it? Okay, Donnell, too much. Okay, Kelsey. Yeah, so that's very important. The context is what you call it. You must make sure that you understand what's happening. Prashni, your side? Laika. Who else is here? Okay. Okay. Who else did I miss over here? Fahim, how do you find it? Bongani, how are you finding it so far? Fahim, yeah?
Well, this question, I'm a bit fuzzy now with the time value of money.
Oh, you bet? What? You bet?
But fuzzy now on the way they're structuring the
Oh, is that
sentence.
what they call
Comes
it?
to time value of money.
Yes, but now what is important, you use this question to train your brain to actually pick up what is important. How does it fit the how does it fit the 5 principles and so forth. So you kind of, now obviously you can't do this in the exam, that's why you're doing it now. So after this, go through it again, and then just in whatever way makes sense to you, try to train your brain how to pick up on the information, how it's fitting into the various columns. Why does it make sense? Because remember, the whole point over here is you obviously, the whole point is you're trying to develop yourself and all of those type of things. And in order to develop yourself, you're going to train your brain to do certain stuff. So you need to find a way to train your brain to how to think through things. But remember, the trick over here is not to overcomplicate it. If you're going to overcomplicate and overthink, your brain is gonna be go haywire. So you need to find a way that is still simple to understand. Remember, based on neuroscience, whilst we are thinking all of these type of things, it is just basically hopping around in your brain. I don't know, there's a word they use. Okay, so it's just jumping around until you basically go and rest, right? Until basically you go and rest. So the subconscious mind makes all the necessary connections, but the subconscious mind really operates well when the conscious mind is asleep. So when you are sleeping, the conscious mind is asleep. So that is when the subconscious mind can do its great work. And that is why they always tell you to go to bed. First, write down, if you read self-help books, self-improvement and all of those other stuff, and you want certain goals, write down the goals at night. Before you go, read it to yourself, tell yourself a story, or look into the mirror. Like if you read the book, Think and Grow Rich, they will tell you that he gives you 6 questions to answer. And it tells you every night before you go sleep, read it out aloud. Every morning when you wake up, read it out aloud. So the point from the reading out at night is that it's in your mind, so that when you go to sleep, that is floating around in your head. And as time passes, the subconscious mind will just make the necessary connections. And like I said, the conscious mind interferes with the subconscious mind. So when you're sleeping, the conscious mind is asleep. So then the subconscious mind can do its work in peace. Okay, seems far-fetched. Like when I first got to know about it, what you call it, but I read quite a few of things on it, articles and so forth, and it all is telling the same thing, and it's all based on latest science. Okay, so if you follow certain things, it can work out. So you don't want to complicate your life, but you need to take now after this class, maybe take a break, and then immediately after your break, try to make the necessary connections and just keep it floating in your head. Think about it if you can't get it, right? If you get it, happy. But if you can't get it, just float around. So when you go sleep tonight, hopefully when you wake up, it will make your subconscious mind have made the necessary connections for you to figure out how to understand this thing. But what's important use this complex question to simplify capital budgeting and to simplify your understanding of the 5 principles. After you are done with this complex question, try to let this be a way of how you're going to read going forward. So that no matter what they present to you, you will be able to pick it up. If you read, they're testing the exact same principles every time capital budgeting comes out. But try to compare maybe the last 4 capital budgeting questions. The scenario is different every time, but what they're testing is exactly the same. So you need to pick up those type of connections. Okay, but I'm going to continue now so we can finish in time.
Just a quick question. Everything you said makes sense now. I just want to know why are we starting in 2019? It says the first 2 years we are in the construction phase.
Okay.
And we are operational at the end of the
year
first year.
one. So year 1 is 2020, right? So year 1 is 2020, year 2 is 2021. The first 2 years is 2020 and 2021. So year 1, 2020, year 2, 2021. You will always have a year 0. Remember, each column represents the end of the year. 2020 represents the end of 2020. 2021 represents the end of 2021. 2022 represents the end of 2022, and so forth. So, if an amount happens, if a cash flow takes place at the beginning of 2020, then you can't put it into 2020 because 2020 represents cash flows taking place at the end of 2020. So if a cash flow happens at the beginning of 2020, you put it into the previous year because the previous year represents, so the previous year, 2019, represents the end of 2019, which is the same thing as the beginning of 2020. So the first capital expenditure happened at the beginning of 2020. You can't put it into 2020 because 2020 represents the end of 2020. So where do you put it? You want it at the beginning of 2020. So the beginning of 2020 is the same thing as the end of 2019. So that is a fundamental principle. They're very strict on it because it's one of the 5 fundamental principles of capital budgeting. So you must make sure you slot in the right columns. I think it was a UNISA question that I saw. I think it was a UNISA. I remember it was different universities question papers I work with, but I think it's a UNISA question paper. They don't only not give you marks if it's in the wrong column, but if you consistently put in the wrong column, they subtract marks. I think the one question paper, depending on how much the marks were, subtracted about 5 marks if you put it in the wrong column consistently. They're not going to subtract 5 marks if you put 1 in the wrong column. But let's say everything you're putting in the wrong column, you're not only losing the marks, you're also going to be subtracted 5 marks because of the fundamental principle. In accounting, in the accounting area, like when I say accounting, I'm talking about tax, accounting, all of those type of stuff. They subtract marks if you consistently apply the incorrect fundamental principle. So just be aware this is a fundamental principle. So make sure you spend time for him to get the columns correct because the columns represents the timing of cash flows. So just be aware of that. Okay, so that is working capital. They said at the end of the period, working capital, you will claim back 90%. So they said, with the balance happening the following year, only 90 cents in the rand of the invested working capital will be recovered at the end of the project. So at the end of the project, you will recover working capital. The end of the project is 2020. You will recover all the amounts, that plus that, but only 90% of it, times 90%. A rule of capital budgeting, you should have seen it in the notes, that capital, if they're silent, if there is capital budgeting and they don't give you any information, then you must know capital budgeting, sorry, not capital budgeting, working capital. So if there is working capital in a capital budgeting question, and they are silent on information about working capital. Then you know there is, they're giving you the amount, and if they're silent, working capital, the outflow always happens in year 0 because you need the working capital at the beginning of the project. So the beginning of the project, meaning the beginning of year 1, but you can't put it into year 1 because year 1 represents the end of year 1. So therefore you put it into year 0. So if they are silent, working capital happens at the beginning of the project, so it will happen in year 0. And you will always recover it at the end of the project. Okay, in this, so generally you recover what you spend. In this case, they're telling us that we're not going to recover 100%, we're only recovering 90%. So just be aware of that. Working capital, the outflow happens at the end of the year. The outflow happens at the beginning of the project, year 0, and you will recover it at the end of the project. So just to make sense, how does this make sense? Let's just picture, we all understand the business of Pick n Pay and of Checkers, right? So let's assume Pick n Pay one product, Coca-Cola. Let's assume they're only running for 3 years, or let's even just say, yeah, let's say 3 years. Okay. In order for Pick n Pay to make, so the beginning of the year is this year. Okay. So they're opening up the Pick n Pay store, only selling Coke. So the store opens at the beginning of 2021. It's going to run in 2021, 2022, 2023. Okay. In order for them to make sales, they need their stock. They need the inventory. They need the groceries in the store. In our case, Coca-Cola. So they need the Coke. In order to make sales from the first day, when do they need the Coke? They need the Coke at the beginning of the first day. So that is why they'll have the Coke the day before, because they will pack the stores. So your Coke will be there at the beginning of the first year. Where do we, so we incur the cost at the beginning of the first year. Where do we put the cost at the beginning of the first year? In the end of the previous year, which was year 0. Now year 1 happens, Coke gets sold. So there's no more Coke available, but they can operate in year 2 as well. So in order to have Coke in year 2, they will spend money in year 1. And so now they spend the same amount of money in year 1, the Coke gets sold in year 1, in year 2. The end of year 2, there's no more Coke, but they're still going to operate in year 3. So what will happen? They'll need Coke for year 3. So they'll buy Coke again at the beginning of year 3, which takes place in year 2. And then at the end of year 3, they make their money back. But they're not going to buy more Coke because they're no longer going to operate. So what did they do when they made the sales? They recovered back the cost price of the working capital. And that is why you're recovering your working capital, because you're not going to spend this money to buy more working capital because you're no longer operating further. So that's just important to take note. So that is the reason why working capital is an outflow in year 0 and an inflow in the end of the project. So just be aware of that. Okay, so now we will go and move on to point 3. So now we're going to deal with sales. So they're telling us that the young designers have signed a 5-year agreement to design the clothing range to be sold at the 350 stores. The range entails, okay, we know that, the expected number of units to be sold by each designer per annum are given below with a starting average price per annum. The Arise and Dream clothing line is priced at a markup of 50% on costs. Manufacturing costs includes designer fees paid to the 4 designers. Okay, so there we can see we have 2020, 2021, which is 55%, then it is 90%, and then it is 100% going forward. So now we will be able to work out the various percentages. So now we're going to work out the sales, and then once we have the sales, we'll be able to work out the cost, because remember, cost price is 50%. Cost price is 50%. The markup is 50% on cost. Okay, so let's have a look. So now we can work out the sales for each designer. So I'm going to work out working. They were working we're busy with now. Okay, so on working 3, we're going to work out sales. So working 3, we're going to have details. We're going to have here 1, and now 2021. We just do this 2021, 2022. So we're going to have full capacity units. We're going to have average selling price. Now we're going to have units. Okay, so it's going to give us our units. Then we're going to have average selling price. And then we're going to have increase percentage. Okay. See this question, I'll come now there. And then it's going to give us revenue, sales, revenue, and then we can work out the cost price. Okay. And we just have to replicate this for each designer. Okay. Let me just see. Someone have a question. Okay, it's fine. So let's have a look. So we're working with Cherry. So we know full capacity. Full capacity is 2,000, but that is per store. We need to multiply it by the number of stores. So just make sure I'm putting the right numbers. Okay, so 2,000 full capacity times 350 stores. Okay, so let me just see if I'm doing this right. 2,000 per store. Okay, so each year it will remain the same. Then they told us in year 1 it is 55%. In year 2 it is 90%, and then year 3 100%. Okay. Okay, so we get the number of units. So there's a number of units. Now I'm going to get the average selling price. Okay, so the average selling price, if you look at point number 2, they said the average price per unit is the price at the start of the construction phase. The selling price will increase by 6% per annum. Okay, so remember what was the start of the construction phase? 2020. Okay, so therefore, so what's important to take note, the average selling price, they're telling us is 200 Rand. Now that is at the start of the construction phase. The start of the construction phase happened in 2020. So therefore, the 6% increase will happen from 2021. So that's very important to take note. What's important to take note is when does the price increase? Okay, so if the 200 Rand was the price in 2021, the increase only happens from The increase only happens from what now? The increase only happens from 2022. But because the price that they gave us is the price in 2020, the increase starts from 2021. So that's another aspect to take note, is when do you apply the increase? Do you apply it from 2021 or do you apply from 2022? If the 200 Rand was the price for 2021, then the increase only starts from 2022. But they told us that that 200 Rand is the price at the start of the construction phase. The start of the construction phase was 2020. So therefore, the increase starts from 2021. Very important. Okay. So this is just going to equal the new price, that multiplied by 1 plus the increase rate. Okay. And now we can work out revenue. So revenue is going to be 380 number of units for the 2021 year, multiplied by the original price, the 2020 price, multiplied by the growth rate. 1 plus the increase rate for 2021. So that is our sales revenue. Okay. Similarly over here, it is the number of units in 2022 multiplied by the price of 2021, but you must increase it for the growth rate. Okay. So now I will just go and drag the formula across. Cost price is, it was a markup of 50% on costs. Because it is a markup on 50% on costs, okay, so the cost price will be 100. So cost price is 100. So, okay, so 100. So it's markup on costs. So therefore, we'll divide by 150, okay, multiplied by the selling price. So there we go. Okay, so now we can plug that in, but we're not going to plug that in now because we need to do for the rest. So I'm just going to copy and paste this now. Who's the next one? Who was the next person? Cherry, and then it was Lace. The units remains the same because they all had 2,000 units and they all have the same expected capacity and the whatever. It just their pricing changes. Lace's pricing is 150. So all I'm going to do, I'm going to change the 150 and then everything will fix itself. Okay. And then I'll do the same. The next one is imprint. The units remains the same, but the pricing changes. His pricing is 150 also. Okay, so everything fixes itself. Then the last one, I don't know what's the last one now. The last one is style for all. So I'm just going to say style. His price is 100. Okay, everything else remains the same. Okay, so now we can get total revenue and total costs. Okay, so now I can say total revenue and total costs. Okay, so total revenue is going to be the sum of the four. So revenue of cherry plus revenue of imprint lace plus, did I miss someone? Okay, let me just go back. Okay, so it is revenue of cherry plus revenue of lace plus revenue of whatever that is, imprint plus the revenue of style. Okay, so there's a total revenue. If I drag this formula down, it will work. It will give me the total cost, and then all I can do is drag it across, and it gives me for all. Okay, so there we go. So this is going to be C68 and C69. C68, C69. C68, C69. Okay, so it is sales, this cost of sales or manufacturing costs. Okay, manufacturing costs. Okay, so 2021 sales is equal to C, what was it? C69. C69. No, C68, C69, C68. Okay, the cost is an outflow, so we have a negative C69. Okay, so there we go. Now I can just drag this formula across. There we go. You can just check that the numbers is right relative to whatever we had. And this is going to be working 3. Okay. Now that was the cost over there. All we need to do is have operating trading costs. So they say the expected operating costs will amount to 30 Rand per annum for all participating stores. These operating costs will be incurred the same time the revenue is realized. Okay. So 30 per annum. Okay. So that is operating costs. Then we have a 3D marketing cost. So they're saying payment relating to marketing costs made in advance will be, okay, means that the company will also embark on a 3D marketing campaign for its new clothing range. The 3D marketing will display the new, payment related will be in advance, will be 2 million in the first year, 2 million Rand in the first year of launching the clothing range, but will reduce by 20% based on initial marketing costs in each of the following year. Okay, excluded from the amounts is an annual depreciation. Okay, so we're happy. So what we will just go, so there's operating costs and a marketing cost. So operating costs, there's going to be a marketing cost. Okay, and then we will have I'm going to put in depreciation. Depreciation, we'll tell them it's non-cash flow. So therefore depreciation is just going to be 0. Okay. So you must tell them it is 0 cash flow. Okay. Generally we'll leave it out. So one way to do it, you put it in and show 0. Otherwise you would put a note below your final answer and say cash flow has been, depreciation has been ignored because it's non-cash flow. Okay, so one of the two. Operating costs, 30 million. So the cost, so it's negative 30 million, 30, 1, 2, 3, 1, 2, 3. Okay. You don't have to tell them it's given. They will know you know it is given. Okay, now we're going to have the marketing costs. So the marketing cost is 2 million Rand in the first year. It's paid in advance. Okay, so the first year of launch is 2021. So the marketing costs won't go in 2021. It will happen in advance. So we started launching in 2021. So therefore, in advance will be the year before. So it's going to be negative 2 million. 1, 2, 3. Okay, so there we go. But it's going to reduce by 20% every year. Okay, so basically, we're going to multiply that by 80%. Okay, so each year, drag it across. Okay, it won't go till 2025. Because remember, if we're going to pay something in 2025, that means it's another year happening. It's not. We only have 5 years, so we're going to advertise for 5 years. Okay, so that is 5 years. Okay, so just be aware of that. Now, that is covering that. Okay, so we'll just say Unisa likes workings, so maybe you want to have workings. For me, that's a waste of my time. So I'll tell them that, I'll explain to them that, you know what, it is reduced by 20% each year. Okay, so that is operating costs. We've covered everything in there. We have covered the operating costs. We have covered the marketing costs. We have dealt with the depreciation. Remember, depreciation is non-cash flow, so we don't want it anywhere. Now we come to salaries. They say the company will have to contract. Okay, we know that person. Okay, so we'll likely start at the beginning of 2020 in order to familiarize herself. So she's going to start at the beginning of 2020. Okay. She will be responsible for what? Okay, no interview. So they say no interview has been conducted with her, but her expected salary package for the 2020 financial year will be 900,000 with an expected increase of 8% per annum. Okay, included in this amount is an annual contribution to the retirement fund and a once-off reallocation cost and sign-on bonus. Okay, these amounts will be paid at the start of the contract. Okay. Okay, then there's a agency commission. The payment will be effected at the beginning of 2020. Okay, so we will just have to deal with that now. So we can put in here salaries. And here we're going to have agency. What was it? Agency commission, I think it was called. Agency commission. It was a 120. We'll pay them at the beginning of 2020. So therefore falls into the 2019 financial year. It's a cost. So therefore it is negative. Now we must go work out the salaries. So what was our last working? Working 3. So we go working 4. So a total package. The total package is 982,377. 982,377. Okay, and then once-off payments is a reallocation cost of 38,000 and a sign-on bonus of 100,000. So it's 38,000, 1, 2, 3, plus 100,000, 1, 2, 3. Okay, so therefore, her actual expenditure, her actual costs is, her actual annual package is that. Okay, yeah, so 982, okay, an annual contribution. So, and included in this amount of the fund, okay. So therefore, her annual package is actually 982 minus that, okay. So annual package is 844, and that's going to grow by 8% per annum. Okay, so we go over here. Annual package is equal to 844. So that's what you're going to get in the first year. And then thereafter, it's going to grow by whatever percent. So that multiplied by 1 plus 8%. Okay. Then so remember, at the beginning of 2020, they're going to pay the reallocation cost and the sign-on bonus. So therefore, because it happened at the beginning of 2020, this is a cost, so it needs to be negative. So cost, it needs to be negative. Okay, and the sign-on bonus and the happens at the beginning of 2020. So therefore, we put it into 2019. Okay, so that is our salaries. Is there anything else? Nope. So we've covered everything over there. Okay, so now we have covered everything over there. Okay, so there we go. So now we have covered everything over here. Okay. The only thing we need to sort out is that working two. So remember, right at the question, the internal rate of return they told us was 20%, I think. So here they say, undertake an internal rate of return of at least 20%. So we must use that as our discount rate. So if we go over here, we plug in 20%. So this here is given. So the value is equal to free cash flow 2026 divided by WACC minus the growth rate. So therefore, that will be 149,671. 149,671. 149, where is this now? So this is going to equal to 149,671. Okay, so now we can work out cash flows. What I'm going to give you something for homework for this question, but I'll tell you just now. So if we add up equal sum, okay, so now we're going to need a discount rate. So you want to get the present value. So here we have the discount rate. They told us it is 20%. So now we can get our present value. So we can get our present value. And I'm going to just say cash flow here 0, and that's going to give us our NPV. So it'll give us our NPV. Okay, so when you do your, so I'm going to show you how I'm going to do my calculation. So I'm going to get my present value. So I'm going to use the NPV calculation. NPV calculation. So they want the discount rate first, and then, so Excel and Google Sheets, they don't take into account cash flow 0. They start with cash flow year 1. So now I must take cash flow year 1, cash flow year 2, cash flow year 3, cash flow year 4, cash flow year 5, cash flow year 6. So because they don't take into year 0, it means the amount that they generate is the present value. Okay, so if I want the NPV, I must still take into account the cash flow of year 0. That's just how Excel and how let's go there. That is basically how Excel and how, what did I say now? That is how Excel and how Google Sheets work. So to get NPV, it is going to be that plus that. Okay. So therefore, our NPV is basically negative. Okay, so our NPV is basically negative. In your calculator, when you use your cash flow calculator, you will type in from cash flow 0. You will start from cash flow 0. So the answer that you get will be the 219. But the way Excel and Google Sheets work, they give me the present value. They give me the present value of those numbers. But I don't want the present value, I want NPV. So then I must take present value minus initial cash flow, which will give me that answer. Okay, so just be aware of that. But we're not required to get IRR. I mean, we're not required to get NPV. We need to get IRR. Okay, so we need to get IRR. To get IRR on your financial calculator, you need to work out NPV. Once you have NPV, then can someone just, I don't have a financial calculator here now, but basically you'll press second function. And I think in the second row, so the top row, you have the 5 buttons. In the second row on the right-hand side, the second button from the right-hand side in the second row, I think you'll have as a second function IRR over there. So basically, once you get NPV, you say second function and you press that button. What you must see that I think second function is orange. So you must see in orange IRR, then you know you're using the right button, and that will give you IRR. For Excel, for Excel and for Google Sheets, they have a separate formula for IRR. So I'll just do it over here. IRR. So I'll say equal IRR, and I'll open up a bracket. What do they ask me for? They ask me for the cash flow amounts. Okay. So all I do is I work out the cash flow amounts. So I will do cash flow. I'll do that. Equal IRR. So they want all the cash flow amounts. And then they want a rate. So in Excel, whenever you, in Excel and Google Sheets, when you want to calculate a rate, a percentage, you always need to put in a guess, okay? You make it up. In a financial calculator, there's no guess you need to do, but if you use spreadsheets, you need to put in a guess. So I do not make myself think. The guess I always use is 10%. Okay, I just always use 10%. Then I never guess. I mean, then I never have to think. I know I just use 10%. So IRR comes to be 6%. So what do you notice? They want IRR to be 20. The fact that it is 6, it means you won't accept. Okay. So that is basically the answer. So here you can see, so just to show you the decisions. So the decision, NPV decision, this is not part of the answer. This is for you to know. The NPV decision so if NPV is greater than 0, meaning if NPV is positive, then accept. So the other way around, if NPV is less than 0, if NPV is negative, then reject. Okay. I or R decision. If I or R is greater than WACC, or in this case, the internal rate of return of 20%, then accept. If it is less than that rate, then you reject. So in this case, the 6% is less than 20%, so you reject. And it confirms over here, NPV is negative, so you reject. Okay. So in your calculation, you're going to need to work out NPV. Once you have NPV, you just say second function, I or R, and you'll get your percentage. So I told you there's one thing you're going to need to do for homework. Okay, you must, you can do it by this weekend. We never brought in tax, so we need to still calculate the tax impact. Okay, so if you can work out tax impact, give it to me tomorrow. I'm going to have it done by the end of today, and then I will check, then I will share it with you. But I'm not going to put it in now. I'm doing a separate sheet because I want you to download this and do your own tax calculation. By tomorrow, when you submit it, I will share it with you, the tax component. So please attempt it. So do this question, start from scratch, and then include the tax. And then I'll share the tax by tomorrow with you if you have done the tax component. Okay, I need to get going. I have another class now in 3 minutes time. Do you guys have any questions on your side before we stop? So let's go through. Danielle, anything confusing? Anything you learned? All of you, you can think about that question. I'll start with Danielle. She's first on the list here. Okay. Yeah, so I'm going to share the file, right? I'm going to share the folder. So you're going to get an email with the folder. Then you will be able to download everything from there. Okay, so I saw your question, Kayla. I'll respond now. Okay, Fahim, anything confusing? Anything you learned?
No, nothing confusing, fine. I think I'm fine.
Okay, so please make sure you revise the question paper. Kayla, anything else other than what you mentioned in the chat? Kelsey? Laika?
So I learned that I need to pay attention to what the actual context says, because I have done this exam before and I can see where I've gone wrong. So
okay, so that's good to know. Laika?
The big thing I learned was the timing of the cash flow.
Can you hear you?
End of the year. I can hear me now.
Yeah.
Yeah, the big thing I learned was the timing of the cash flows at the beginning of the year, the end of the year. I think I really messed that up when I tried this before.
Okay.
Yeah.
So now, okay, so that is a good. So now you at least know going forward, you can correct that.
Yeah.
The next that is Prashni. Let me just see. Oh, Bunkani, are you here? Yes, okay, Bunkani, you can go.
Yes. Do you hear me?
Yes, I can.
What I have learned is that I must focus on reading and understand the context very much,
Yes.
so that it could be much easier to
So that is very
understand.
important, but also make sure don't overthink, because that can also create. So you never just find that balance of reading with good understanding, but don't overthink. Okay, because when you overthink, then you also can cause you to unnecessarily complicate the scenario. Okay, so just find that balance. Okay, anything else? No. Okay, Prashni, you see. Okay. Okay. So just, yeah, so this is important to make sure you go through all of those. So exam tip, how to tackle the question. It's very important that you understand what the required is asking. That's the first thing to start off with. Once you know what the required is asking, you must have kind of a template in your mind, okay? Like you know the format of setting it up. Then, because you're going to get a lot of information like over here, it's best because if you perhaps maybe in second year or so forth, there's a set template they give you. Cost of expenditure, sales, whatever, right? Don't follow that. So what you have that idea in your head. So like this template in your head, but when you answer, go in accordance with the information that is provided. Okay, so if obviously the only thing you have to do last is tax, but like for example, like you saw this thing over here, this thing I got first. I started with that. I didn't wait till I come at the end of the question because that was the first information I read that I know impacts my calculation. I'm going to plug it in. So as you go through the information, plug in there and then. You do everything there and then. The only thing you have to wait is for tax, because tax is dependent upon the final answer. So just that is the best tip I can give you. It works for every question. This is MAC, financial management, accounting, tax, whatever you want to call it. Go in chronological order, step by step. And also by understanding the required, it will tell you where you need to look for information. Like I told you over here, and all the information under each section, about 95% will be under there, if not more, if not 100%. In this case, virtually 99.9% of the information was where we needed it in that part A. The only thing that was elsewhere was that discount rate. Okay, only thing that was elsewhere was that discount rate. So that is how you can go through it. But before you start the question, just remind yourself of the key principles of capital budgeting before you attempt the question. So for you guys, redo this question and complete the tax. And then I'll share this with you by tomorrow. I'm going to add you now to the folder so you can access it immediately. Okay. Let me just quickly go do that before I cancel. So if I go, I'm going to so I'm going to add it to the folder now. Okay, so I sent it to you guys now. So for example, if you don't have a Gmail account, you're going to have to send me an email back. They're going to send you a link. You're going to try to open it, and then they're going to ask you to request for email. So for example, like Kelsey, you don't have a Gmail account. The email I have is not Gmail account. You have your work account. So all of you are going to get the email, but those who have a Gmail will be able to access it immediately. When you have a non-Gmail account, Gmail requires you to request access. So then I'll get an email to say you requested access, and then I will provide you access in that email. once I get it. Okay, so I'm gonna have to stop over here. I have another class now. If you have any questions, let me know. I hope you found the class beneficial, and I hope you learned. What's important is exam technique and then content. Practice on exam technique as well. Okay. Thank you very much, guys. I'll see you next week for the next information. If you're writing online, I would advise using Excel. But if you must practice now with Excel. If you can't use Excel for the first time in the exam. So if you plan using Excel, practice now with Excel, so that when you come to the exam, Excel is nothing new. Excel is something you're used to. Okay, but I would advise Excel. Yeah. Okay. Okay, guys. I'll see you guys. I'll see you guys next week. Okay. For MAC3701, you on tomorrow. Okay. Bye bye.